let's talk about life insurance. You've probably heard the term, and maybe it sounds a little complicated. But honestly, it's all built on one very simple, very human question. So, in the next few minutes, we're going to cut right through the jargon and lay out exactly what it is, how it works, and what it could mean for your family's future.
And here's that question, right up front. If you weren't here tomorrow, what happens to the people who count on you? Now, this isn't about being gloomy, not at all. It's about being practical. It's about planning for their security, no matter what.
And that right there is the whole point of life insurance. It's designed to be that financial safety net. It's a plan you put in place today to answer that tough what-if question and make sure your family is protected from a financial crisis.
So who needs this safety net? Well, just think about it for a second. Who relies on your income? Are you a parent? Do you have a mortgage payment every month? Are you a business owner? Or maybe taking care of someone with special needs? If anyone's financial well-being is tied to your paycheck, then you've got a clear need for this kind of protection.
Okay, so how does this safety net actually get built? Let's forget all the industry jargon for a minute because the concept itself is incredibly straightforward. At its heart, life insurance is just a simple financial swap. Let's look at both sides of that deal.
On one side of the swap, you've got your part. This is called the premium. It's basically a small, regular payment. You might pay it monthly or once a year that you make to an insurance company. Think of it as your side of the bargain.
And here's the other side of that bargain, the really powerful part, the death benefit. If you pass away while the policy is active, the insurance company gives your family a large lump sum of money. And this is so important, it's typically tax-free. This is the financial protection you've been paying for.
So you see the exchange right here. It's that simple. You swap small, predictable payments now for the guarantee of a large, protective payout later, right when it's needed most. You're basically transferring the biggest financial risk your family could face from their shoulders over to the insurance company. All right, so you get the basic swap. But when you start looking, it seems like there are a million different kinds of insurance out there, right? Well, the good news is pretty much everything boils down to two main paths. Understanding these two is probably the single most important decision you're going to make.
So on one side, you've got term life. This covers you for a specific period of time, say 20 years while your kids are growing up. It's pure, simple, no-frills protection, which means it costs a lot less. The best analogy? It's like renting protection. Then you have permanent life. This covers you for, well, your entire life. It also has a savings component called cash value, which makes it more expensive. So this is more like owning your policy.
Now, inside that permanent category, you'll hear a few different names thrown around. Whole life has fixed payments and guaranteed growth. Universal life, or UL, gives you more flexibility. Some can even tie their growth to something like the S&P 500. But don't get too bogged down here. They all share that same core idea, lifelong protection plus that cash value component, which is kind of like a savings account built right into the policy.
All right, we've talked about the why and the what. Now we get to the really personal part. How much coverage is actually enough for you?
A general rule of thumb you'll hear a lot is to aim for coverage that's about 10 to 15 times your annual income. The idea is to replace your future paychecks and give your family a really significant financial cushion to live on.
But, and I can't stress this enough, that is just a guideline. It's a great place to start thinking, but the right number for you depends completely on your story. A simple rule of thumb doesn't know about your mortgage or your kids' college dreams or your specific debts.
And this is what we mean by your story. To find your real number, you take that 10 to 15 times income figure, and then you add in the big stuff. What would it take to pay off the mortgage, to fund college? Then you can subtract what you already have in savings. This little bit of math is what tailors the coverage to fit your life like a glove.
So now you've got a target number in your head. What's next? Well, this last section is your action plan. It's a simple, smart buyer's checklist to help you get it done right.
Look, breaking it down like this makes it so much less intimidating. First, just define the problem. Is it the mortgage, income replacement? Next, choose your path. Do you need temporary term coverage or lifelong permanent? Step 3 is a big one. Always compare quotes. Prices can be wildly different. Then you'll apply and go through what's called underwriting. That's just them checking out your health. Be honest. And finally, don't just set it and forget it. Take a look at it every year or so. Life changes.
And hey, everybody wants to save some cash, right? Here are a few legit ways. Paying annually instead of monthly usually gets you a discount. Things you can control, like improving your blood pressure, can make a real difference in your price. And honestly,
One of the best things you can do is work with someone who can shop around at different companies for you, because they all look at health and lifestyle a little differently. Finding the right fit can save you a ton.
And to finish up, let's quickly cover what not to do. Probably the biggest mistake is buying a pricey, permanent policy when a simple, cheap term policy would have solved the problem just fine. Also be careful about adding a bunch of extra features called riders that you might not need. And please, whatever you do, never ever cancel an old policy until you have confirmation that the new one is 100% active.
So we'll end right where we started, with the question. But this time, it's not about insurance policies or premiums. It's about what this tool can actually build. For the people you love the most, what does that peace of mind, that true financial security, what does that really look like?